December 2024 has been a roller coaster ride for the Dow Jones Industrial Average. The month began with optimism, but the Federal Reserve's actions threw a wrench into the gears. Investors are now grappling with uncertainty as they try to decipher the market's direction. The Dow, a key indicator of the U.S. stock market's health, has experienced significant volatility. This volatility reflects the broader uncertainty that has gripped the market. Investors are torn between positive economic indicators and the Fed's cautious outlook. The Federal Reserve's decision to cut interest rates in December 2024 had an unexpected effect on the stock market. The move, which was widely anticipated to boost investor confidence and stimulate economic growth, instead sent shockwaves through the financial world. Analysts had predicted a positive reaction, expecting that lower borrowing costs would encourage spending and investment. However, the reality was starkly different. Instead of rallying, the market took a nosedive. Investors who had been on edge due to ongoing economic uncertainties reacted with panic. The sudden drop in interest rates was perceived as a signal that the Federal Reserve was more concerned about the economy than previously thought. This led to a massive sell-off, as traders scrambled to offload stocks. The Dow Jones Industrial Average, along with the S&P 500 and the Nasdaq Composite, experienced their worst single-day performance in months. The Dow plummeted by over 1,000 points while the S&P and Nasdaq each saw declines of more than 3%. This dramatic downturn wiped out billions of dollars in market value in just a few hours. The Dow's decline was particularly noteworthy, marking its longest losing streak in decades. This unprecedented drop raised alarms among investors and policymakers alike. Historical comparisons were drawn to previous market crashes, with some experts warning that this could be the beginning of a more prolonged downturn. This downturn underscores the market's sensitivity to the Fed's actions and pronouncements. Financial analysts were quick to point out that the market's reaction was a clear indication of the fragile state of investor sentiment. The Fed's attempt to provide economic stimulus had inadvertently highlighted underlying weaknesses in the economy. The rate cut, while intended to stimulate the economy, seemed to have the opposite effect, at least in the short term. The Federal Reserve now faces the challenge of restoring confidence and stabilizing the markets. Moving forward, it will be crucial for the Fed to carefully communicate its strategies and intentions to avoid further market disruptions. The coming weeks will be critical in determining whether this rate cut will ultimately benefit the economy or if it will be remembered as a misstep in monetary policy. Federal Reserve Chair Jerome Powell's cautious tone following the rate cut added fuel to the market's fire. Powell acknowledged the strength of the U.S. economy, but expressed concerns about persistent inflation. He hinted at a slower pace of rate cuts in the future, which spooked investors. Powell's comments highlighted the Fed's delicate balancing act. The central bank aims to support economic growth while keeping inflation in check. However, striking this balance has become increasingly challenging in the current economic climate. While the overall market suffered, some sectors fared better than others. Sectors like consumer discretionary and real estate, which are sensitive to interest rate changes, experienced the most significant declines. These sectors are particularly vulnerable to economic slowdowns and fluctuations in consumer spending. On the other hand, certain companies and sectors showed resilience. Jabil, a manufacturing solutions provider, saw its stock surge after exceeding earnings expectations. This positive performance demonstrates that even in a volatile market, pockets of opportunity exist for investors. Section 5. Broader market trends, mixed signals amid volatility. In this section, we delve into the complexities of the current market environment, where conflicting signals create a challenging landscape for investors and analysts alike. Despite the December slump, the broader market trends paint a more nuanced picture. While some sectors have experienced downturns, others have shown resilience and even growth. This divergence highlights the importance of a diversified investment strategy. The labor market remains strong with unemployment at historic lows. This robust employment scenario is a cornerstone of economic stability, providing consumers with the confidence and means to spend, which in turn fuels business growth. This positive indicator suggests a healthy economy, which could bolster stock prices in the long run. Consumer spending, a critical component of economic health, continues to show strength, reflecting the underlying confidence in the market. However, the CBOE Volatility Index, also known as the fear gauge, remains elevated. This index measures market volatility and investor sentiment, and its current high levels indicate that uncertainty and fear are still prevalent among market participants. This suggests that investors are still apprehensive about the market's future direction. The elevated volatility index reflects the ongoing concerns about potential market corrections and economic downturns, making it a critical factor to watch. The mixed signals from economic indicators and market sentiment contribute to the ongoing uncertainty. While some data points to a strong and growing economy, other indicators raise red flags about potential risks and challenges ahead. This complex interplay of factors underscores the need for careful analysis and strategic planning in navigating the current market landscape. Section 6. Economic Indicators. A story of resilience and uncertainty. The U.S. economy continues to show signs of resilience, with steady economic growth and a robust labor market. However, inflation remains a concern, prompting the Federal Reserve to proceed cautiously with its monetary policy. The Fed's projections suggest that inflation may not return to the target rate of 2% until 2027. This persistent inflation poses a challenge for the central bank and creates uncertainty for investors. Section 7. November Rally and December Slump, a tale of 2 months. The stock market is often a reflection of the broader economic and political landscape, and the final 2 months of 2024 were no exception. In this chapter, we delve into the contrasting fortunes of November and December, exploring the factors that drove the market's dramatic swings. The stock market's performance in December 2024 stands in stark contrast to the previous month. While November was characterized by a surge in investor confidence, December brought a wave of uncertainty and caution. This shift was not just a minor fluctuation, but a significant reversal that caught many by surprise. November saw a remarkable rally, fueled by post-election optimism and holiday shopping. The election results had a stabilizing effect, leading to a surge in consumer spending and investor confidence. Retailers reported record sales, and the stock market responded with enthusiasm, pushing major indices to new heights. The Dow Jones, S&P 500, and Nasdaq all reached record highs. This period of exuberance was marked by a sense of renewed hope and economic stability. Investors were buoyed by the prospect of a strong holiday season and the potential for favorable economic policies from the newly elected government. However, this euphoria was short-lived. As December unfolded, the market's mood shifted dramatically. Concerns about inflation, interest rates, and the Federal Reserve's policy stance began to weigh heavily on investor sentiment. The initial optimism gave way to a more cautious and measured approach. December brought a reality check as investors grappled with the Fed's cautious outlook and persistent inflation. The Federal Reserve's statements about potential interest rate hikes and the ongoing challenges of inflation created an environment of uncertainty. Investors began to reassess their positions, leading to a noticeable decline in market activity. The market's swift reversal highlights the importance of considering both short-term and long-term factors when making investment decisions. While the allure of quick gains can be tempting, it's crucial to maintain a balanced perspective. The events of November and December 2024 serve as a reminder that the stock market is inherently volatile, and staying informed and adaptable is key to navigating its ups and downs. Section 8. Shining Stars. Top-performing stocks in the Dow. Despite the overall market downturn, certain stocks within the Dow Jones Industrial Average managed to shine. Companies like Vistra, Palantir Technologies, and Texas Pacific Land outperformed the broader market, demonstrating resilience and growth potential. These top performers highlight that even in challenging market conditions, opportunities exist for investors to identify and capitalize on companies with strong fundamentals and growth prospects. Section 9. Investor's Guide. Navigating the Road Ahead. As we head into the new year, investors should brace themselves for continued volatility. The market is likely to remain sensitive to economic data, Fed pronouncements, and geopolitical events. Staying informed, diversifying portfolios, and focusing on long-term investment goals will be crucial for navigating the road ahead. It's a time for caution, but also a time for opportunity for those who make informed decisions. Remember, as always, to buy and hold.